What's up, guys? Welcome back to another video. Today we are going to talk about the stock market because there's a new piece of information that I think will be useful for people to know. And this is a new concept to me. I read this article from CNBC and it immediately made sense to me because this is logically how I think. But this article says there's a wave of selling estimated to be in the billions that's about to hit the stock market. The final day of June is a week away, and Wall Street is already speculating that there's the potential some asset allocators, like pension funds, could take the big gains from the stock market and move them into bonds. What this means is there might be a massive sell-off in the stock market. The stock market will go down significantly in the next week or two because this is the end of the second quarter. And let me explain the math of why they have to do this. This is not a human decision. This is a kind of like a prerequisite or a demand. Based on the guidance or outline of their pension funds, they have to do this. So with the S&P 500 up more than 21% for this quarter, strategists are handicapping the likelihood that pensions and other funds and investors will sell some of their big stock market gains and buy bonds in the course of this week. Some are even speculating that this could be a sizable move by pension funds into bonds, with some estimates ranging from $35 billion to $76 billion. What is happening here is the process of rebalancing. Rebalancing is the process of realigning the weightings of a portfolio of assets. Rebalancing involves periodically buying or selling assets in a portfolio to maintain an original or desired level of asset allocation or risk. So what's happening here, we can use the government's 401k thrift savings plan as an example. The default fund, whenever you become a government employee or a military person, is to get basically deposited into one of these Lifecycle Funds. I don't recommend the Lifecycle Funds, but they're popular, people use them. Every major investing institution has this, where based on your set retirement year, your default allocated into certain percentages. So for example, if you're in the Lifecycle 2030 fund, you're expected to retire in the year 2030. They've given you preset percentages. So the G fund stands for government bonds. The C fund is the S&P 500 index fund. So you're only supposed to be, if you're in the L 2030, you're only supposed to be 30% S&P 500, and about 32% government bonds. However, in the last quarter, the S&P 500 was up 22%, meaning that this wedge of the wheel got 22% bigger. Meanwhile, government bonds are only paying less than 2% a year now. Divide that by 4, the G fund only expanded by 0.6%. So the desired percentages of the fund allocation are completely out of whack because there was the big decline at the end of the first quarter. There probably was a redistribution from bonds to stocks in March, helping the stock market go up. And now that it's gone up so much so fast, the percentages are wrong again. So they're going to have to redistribute from stocks back to bonds. On my channel last month, I made a video talking about why I chose to sell all the stocks in my private brokerage account. I didn't touch my retirement accounts, just my private brokerage account. I was trying to time the market, and that was a huge mistake. I got out when the S&P was close to 2,900. It's gone up, 7, 8, 9% since then. It's back down today, and I think that there will be a dip in the next week or two, but it's not going to last long. So this is my opportunity to get back into some of the stocks that I sold last month because I don't see another 20, 30% drop happening in the near future. Why I don't see a similar market crash to the March one happening in the near future, I covered that in this video, and for fun, we can just recap why that is. Basically, the people have money. Wealthy people, investors, have more money than what they know what to do with. Because of the almost $3 trillion from the CARES Act and the additional funding for the small business loans, and then the $9 trillion that the Federal Reserve has injected into the economy through the bond markets and quantitative easing, interest rates being close to zero, so everybody is refinancing all of their debt to get a lower interest rate. The entire economy is just flooded with cheap money. The total value of the S&P 500 is only worth about $30 trillion. That's a lot, but the federal government has just injected $10 trillion into the economy. So, 30 divided by 10. So it's a third of the value of the stock market. The government has just printed this money and is tossing it out there. I have friends who are not into investing who have been messaging me the last couple of weeks saying, Jake, where can I put my money? My high interest savings account doesn't earn me anything anymore. So there's no good place for investors to put their money. And this is going to cause inflation. It's going to cause asset inflation. Here's an article from the Wall Street Journal. Investors are sitting on the biggest pile of cash ever. What is close to $4.6 trillion. This is $4.6 trillion being held in cash that investors want to put into the market, but they don't feel like there are any good deals there. So if there is a stock market dip in the next week or two because of this fund redistribution from the pensions, it's not going to last. I think the gap will be filled pretty fast. So I view this as an opportunity to get back in. Reflecting on what's happened in the last 6 months in the stock market, it's been a wild ride. It's been crazy the last couple months. And honestly, I made the mistake trying to time the market. I should not have sold all my stocks. The better option at the time would have been to just stop buying, to hold everything I had, but then start building up a cash reserve, waiting for a second dip. I got greedy, thinking that I could sell everything and then buy back in at a lower price. It could happen in the next week or two, that's why I'm making this video, but it also could not happen. When you look at the long-term trend of the stock market, it always goes up over time. Betting that in the long run it won't continue going up at the extraordinary rate it's been going up for 100 years is the wrong play. And I have lots of people who comment on my channel saying, you're going to lose everything, you got to get out, stocks are a bad deal. But the math isn't there. People who stay in the market long term, buy and hold, are better off than people who... that's the thing, is that there really isn't good places to put your money right now. Okay guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I talk about finance and investing. And if you have any comments or questions, leave me one down below. I love hearing from you guys. Till the next video, take care.